Welcome back to the deep dive. Today we're going to do a deep dive into advanced portfolio management.
Oh, yeah. This is a good one.
Yeah, this one's been recommended by a bunch of listeners, and it seems like it's pretty popular among,
Equity analysts.
equity analysts
Mhm.
and portfolio managers.
It is, it's got a reputation as being kind of a practical guide.
Okay.
It's not just a bunch of,
Theory?
yeah, theory. It's really trying to connect the dots between
Right.
the kind of high-level concepts and like the actual decisions investors make.
The real world.
Yeah,
So is this like particularly relevant now with all this new technology and data coming out?
absolutely. And the book actually acknowledges that, and it talks about,
Okay.
these advancements, but it stresses that you can't just rely on
Oh, so it's not just like a,
the new shiny toy.
plug and chug kind of
Right.
system.
You still got to do your fundamental analysis.
Okay, so
Huh.
where does it even begin? Like, how does it approach turning
Good part.
investment ideas into profits?
By addressing a fundamental challenge that I think any investor faces,
Okay.
which is, recognizing the limitations of your knowledge.
Oh, interesting.
It encourages you to think about, what are the returns that are driven by kind of broader
Right.
market forces, and what are the returns that you can potentially anticipate through like a deep dive.
Company specific.
Yeah, company-specific analysis.
So it's like separating the signal from the noise. You're not
Yeah.
just going to
Exactly.
ride some market trend.
Yeah, it's about figuring out where your edge is
Okay.
and what you can actually forecast and what you can't.
So where you can add value.
Exactly. And they call it invest in your edge and hedge the rest.
Oh, I like that.
So basically, figure out where you actually have insight
Uh-huh.
and then structure your portfolio to kind of capitalize on that while minimizing your exposure to the stuff you can't predict.
Right. So minimizing risk is a
Huge part of it.
key element of this.
Absolutely.
Okay.
And the book really dives into alpha and beta, which, alpha being your outperformance over the market, that's kind of like your key to success.
Right.
And beta being kind of your market sensitivity,
Okay.
which can be a double-edged sword. It can help you or help you.
It can amplify both
Exactly.
gains and losses.
Exactly. So
Yeah.
understanding that relationship is crucial for managing risk and getting the returns you want.
So how do they suggest that we do that manage the risk?
Well, they introduce the concept of multi-factor models,
Right.
which I like to think of them as tools that help you understand the hidden drivers of stock returns.
Okay.
It's kind of like an X-ray. You're kind of looking beneath the surface to see what's really going on.
Right.
There are different types of models.
Okay.
Some are based on fundamentals, some are based on macroeconomic trends, some are statistical.
Okay.
But they all try to do the same thing, which is break down a stock's return into its core components.
So what are some examples of these hidden drivers that we might be missing?
Well, some of them are pretty intuitive, like country and industry factors.
Right. So like where a company is and what sector they're in.
Makes sense, right? Like,
Yeah.
obviously, location and industry have a big impact on performance.
Yeah.
And then you've got beta and volatility factors.
Okay.
So that's measuring how sensitive a stock is to market swings, how risky it is.
So if there's like a volatile market, a high beta stock could
So
be
it could mean you make a lot of money or you could lose a lot of money.
like a high stakes gamble.
Yeah, in a way. And then you have technical factors like momentum.
Oh.
Which, a lot of people look at price trends to try to predict where stock's going.
Okay.
And of course, you got the valuation factors like
Right.
book to price,
The classics.
the classics trying to find those undervalued companies.
Right. So you're not just going with your gut or like what's popular. You're using like a data-driven approach
That's the idea.
to figure out.
You can really understand what's driving the price.
Okay.
Then there are these things called endogenous factors,
Yeah.
which are more about market sentiment.
Okay.
So like think about hedge fund holdings.
Okay.
If a lot of big players are buying a stock,
Right.
that could be a signal that they're confident, but it could also mean it's a really crowded trade and there's a lot of risk there.
Like the whole meme stock thing.
Exactly. Like that's a perfect example.
Yeah.
Some people made a lot of money, but a lot of people got burned
Right.
because they got caught up in the hype.
So we've got all these factors influencing stock returns, but how do we actually use them to build a winning portfolio?
That's where sizing comes in.
Okay.
There's a whole chapter on effective heuristics for alpha sizing.
Heuristics.
Yeah, which are basically practical rules of thumb.
I like rules of thumb.
Yeah, for translating your insights into actual positions.
Give me an example.
So one of the most popular ones is the Sharpe ratio.
Okay.
You probably heard of that.
Yeah.
Which measures risk-adjusted return.
Okay.
So you're not just chasing the highest return, you're looking for the best balance of return and risk.
Okay.
Like, let's say you have two investments. One has a 10% return, but it's really volatile. The other one has an 8% return, but it's super stable.
Right.
The Sharpe ratio helps you compare those and figure out which one is actually giving you the most bang for your buck
Right.
in terms of risk and return.
Okay.
The book also talks about moving beyond gut feeling
Okay.
and when you're estimating expected returns.
So it's not all intuition.
Not just intuition. You got to
Yeah.
use some data.
Yeah.
So there are methods like a proportional rule,
Yeah.
which is a simple sizing strategy, and then there's risk parity,
Okay.
which focuses on balancing risk across different investments rather than just concentrating your bets.
Right.
And then you've got the more mathematical approach, mean variance optimization.
Oh, yeah, I've heard of that one.
Yeah, which
Wow.
tries to find like the perfect portfolio mix
Right.
to minimize risk and maximize return.
Okay.
But the book is careful to point out that,
Yeah.
mean variance optimization, it sounds great in theory, but in the real world, markets are messy and unpredictable.
Right. It doesn't always work out that way.
So they talk about shrinkage techniques,
Okay.
which basically try to make mean variance optimization more robust and less sensitive to those unexpected market shifts.
Okay. So even with the fancy math, you still need a little bit of,
Common sense.
common sense and skepticism.
Absolutely.
Okay. So we've laid the groundwork, but let's dive into how we actually manage this factor risk.
All right, let's do it.
This is where it gets interesting.
This is the real skill
Yeah.
in portfolio management.
I'm all ears.
So managing factor risk, it's kind of like navigating a ship through choppy waters.
Okay.
You got to be constantly aware of like the currents.
Got some warning signs.
Yeah, and adjust your course accordingly.
Okay. So how do we do that?
Well, one of the most obvious signs is when factor returns start shifting suddenly.
Oh, okay.
Like, you have these things called factor rotation,
Okay.
where a factor that's been performing well can
Right.
suddenly reverse course.
And then if you're heavily invested in that,
You can get caught off guard.
it's like musical chairs.
Exactly. You got to make sure you're not left standing when the music stops.
So what are some other red flags?
Well, another one is when your portfolio's performance starts to deviate from its historical patterns.
Okay. So like if I'm used to seeing consistent returns from tech stocks,
Right.
but then they start underperforming.
That could mean something fundamental has changed,
Okay.
and you need to reassess your exposure.
Got it.
So the book talks about tactical factor risk management,
Okay.
which is basically reacting to these market shifts in real time.
So you're not just setting it and forgetting it.
No, you got to be like a chess player,
He's thinking ahead.
keeping ahead, anticipating your opponent's moves,
Right.
and adjusting your strategy.
So it's dynamic.
Very dynamic.
Okay.
But then there's also strategic factor risk management,
Okay.
which is more about setting those long-term guidelines
Okay.
and limits for your portfolio.
Like guardrails.
Yeah, guardrails to keep you on track,
Right.
even when you might be tempted to chase the latest hot stock.
Right. So what kind of guidelines are we talking about?
Well, one of the key things is setting an upper limit on factor risk.
Okay.
The book argues that if you let factor variance get too high,
Right.
your risk-adjusted performance is going to suffer.
So your returns are basically being driven by luck, not skill.
Exactly. You want your skill to be the main driver.
Makes sense.
So they suggest aiming for an idiosyncratic variance percentage of at least 75%.
Okay.
Which means basically 3/4 of your risk should be coming from your stock-specific insights.
Oh, okay. So you're really betting on yourself.
That's the idea.
There you
You're
go.
tilting the scales in your favor
Right.
by maximizing the impact of your expertise and minimizing those external forces.
Okay. So you're managing your stock-specific risk, but what about your overall market exposure?
Yeah, that's important too, especially if you're aiming for absolute returns.
Okay.
You don't want to lose everything if the market tanks. So they provide a formula for calculating like the optimal percentage of your portfolio
Okay.
to allocate to the market
Okay.
based on your risk tolerance and your expected returns.
So it's like finding that sweet spot.
Yeah, you want to capture some of the market upside,
Right.
but you also want to protect yourself from the downside.
Exactly.
Another key guideline is setting limits on single stock holdings.
Diversification.
Exactly. Don't put all your eggs in one basket.
Yeah.
Even the best investors make mistakes.
Right.
So having a limit helps protect you from those catastrophic losses.
Okay.
And it's not just about diversifying across stocks.
It's about diversifying across factors.
Exactly, because you can have too much exposure to any one factor,
Right.
and that can also increase your risk.
So it's all about balance.
Balance, that's the key word.
Not too much, not too little.
Like Goldilocks.
Exactly.
So they recommend setting these single-factor exposure limits
Okay.
based on your loss tolerance.
Right.
And like the worst-case scenario for that factor.
So basically, how much pain can you handle?
Yeah. You got to be realistic about how much you can afford to lose.
Okay.
Now, once you have all these guardrails in place,
Yeah.
it's time to start thinking about understanding your performance.
Oh.
It's not enough to just look at your profits and losses. You got to go deeper.
You got to dig in.
You got to figure out what's working, what's not.
Really dissect it.
Yeah, this is where performance attribution comes in.
Okay.
It's like taking apart a clock
Okay.
to see how all the gears work together.
So you can figure out which parts of your strategy are working.
Exactly. If you can pinpoint what's contributing to your returns,
Right.
you can double down on that
Makes sense.
and fix what's not working.
Okay, so how do we do that?
So the book provides a framework for decomposing your performance
Okay.
into factor returns and idiosyncratic returns.
Okay.
Factor returns are driven by the market.
Right.
Idiosyncratic returns are specific to your stock picks.
Okay.
So by analyzing those two components, you can start to see where your edge really lies.
So is it skill or is it luck?
Exactly. Are you picking winning stocks?
Okay.
Or are you just riding a wave?
Right.
And they also emphasize the importance of analyzing your stock selection,
Okay.
your sizing, and your timing.
So basically everything.
Yeah, the whole investment process.
Right.
Like how well are you choosing stocks?
Okay.
How are you determining your position sizes?
Yeah.
Are you entering and exiting trades at the right time?
So it's a holistic view.
Very holistic.
Okay.
And they provide tools and techniques for each of those components.
Okay. Give me an example.
Like, for example, you can compare your performance to an equal-weighted portfolio
Okay.
to see how much value you're adding through stock selection.
Oh, that's interesting.
So if you're consistently beating that benchmark,
Right.
that suggests you're actually good at picking stocks.
Okay. But it's not just about picking the right stocks.
No, you also got to be smart about how you trade them.
Right. Trading.
This is where trade efficiency comes in,
Okay.
which is all about minimizing those hidden costs that eat into your profits.
Right. Like transaction fees?
Yeah, transaction fees, market impact, all that stuff.
So it's not enough to just generate returns. You got to keep as much of those returns as possible.
Exactly. You got to be efficient.
Okay.
So the book provides insights into analyzing your trading patterns and figuring out where you can improve.
So you can squeeze out every last drop of profit.
Exactly. Every little bit counts.
Okay, so we've talked about managing risk, understanding performance. Now let's talk about the elephant in the room, managing losses.
Nobody likes talking about it.
No, but we all experience them.
We do.
It's a part of life.
Yeah, and it's a part of investing.
Exactly. So how do we deal with it?
Well, the book gets into this concept of stop-loss strategies,
Okay,
which are basically predetermined rules for when to cut your losses on an investment.
so it's like a safety net?
Yeah, it's about protecting yourself from those really big, painful losses,
Right.
even if it means giving up on some potential upside.
So how do you decide when to hold on and when to actually cut your losses?
That's the million-dollar question, isn't it?
Yeah.
The book goes through a bunch of different stop-loss techniques
Yeah.
and talks about the trade-offs,
Right.
between protecting your downside and maximizing your gains.
Okay.
So they compare things like single threshold approaches,
Okay.
where you set a fixed loss limit,
Right.
versus two threshold approaches,
Okay.
where you kind of gradually reduce your exposure as losses mount.
So it's a little more flexible?
Yeah, it gives you a little more wiggle room.
It takes into account that not all losses are equal.
Exactly. Like a small dip might just be a buying opportunity.
Right.
But a sustained decline could be a sign that something's really wrong.
So you need a plan for different scenarios.
Absolutely. And the book really stresses the importance of discipline here.
Okay.
You got to stick to your plan even when it's tough.
Right. When you see those losses.
Yeah, it's about taking the emotion out of it.
So how do you determine those thresholds? Like, what's a reasonable amount of loss to tolerate before you say I'm out?
Well, the book offers some guidance based on things like your portfolio's volatility and your risk tolerance.
Okay.
They introduce this concept of efficiency,
Right.
which measures the impact of your stop-loss strategy on your risk-adjusted returns.
So it's not just about minimizing losses. It's about minimizing losses in a smart way.
Right. You don't want to be so risk averse that you miss out on potential gains.
Right.
They even use simulations to show you how different thresholds affect performance.
So you can make data-driven decisions.
Exactly. You don't have to just guess.
Okay, so we've covered managing risk, understanding performance, and controlling losses. What's next?
Let's talk about leverage.
Okay, this is where it gets interesting.
This is where things can get a little hairy,
Yeah.
especially if you're managing a lot of money.
Right.
The book has a whole chapter on setting your leverage ratio,
Okay.
which is basically the ratio of your total investment exposure to your actual capital.
So it's like using borrowed money to amplify your returns.
Yeah, but it can also amplify your losses.
Double-edged sword.
Big time.
High risk, high reward.
Exactly.
Okay.
So the book provides a framework for making smart decisions about leverage,
Okay.
taking into account things like your risk profile, your expected returns,
Right.
the potential for drawdowns.
Right, so you don't want to get wiped out.
No, you got to be careful.
Yeah.
And they walk you through the calculations
Okay.
to help you figure out a leverage ratio that aligns with your goals and your risk tolerance.
So it sounds like it's a bit complex, but ultimately it's about giving investors a plan.
Yeah, a plan for using leverage responsibly.
Oh, so you don't blow yourself up.
Exactly.
Okay, so one last thing I wanted to touch on is alternative data.
Oh, yeah, that's a hot topic.
Everyone's talking about it, using credit card data, geolocation data, social media trends.
All that stuff.
Yeah, to gain an edge in the market.
Right.
What does the book say about that?
So the book acknowledges that alternative data can be valuable.
Okay.
But they're also cautious.
Okay.
They say you can't just blindly jump on the bandwagon.
So it's not just about having more data. It's about knowing what to do with it.
Exactly. You got to be smart about it.
Right.
So they outline a framework
Okay.
for incorporating alternative data into your process.
Okay.
And it starts with identifying potentially useful sources.
Okay.
Then you got to extract relevant features from that
Mhm.
data.
Okay.
And then you got to rigorously test those features.
To make sure they actually work.
Exactly. You don't want to be chasing ghosts.
Right. So it's a very data-driven approach to alternative data.
Yeah, you got to be just as disciplined with alternative data as you are with traditional data.
So as we wrap up our deep dive into advanced portfolio management, what are the key takeaways you want our listeners to remember?
I think the biggest takeaway is the importance of discipline and a rigorous analytical approach.
It's not just about gut feeling anymore.
No, you got to have a system. You got to understand what drives returns. You got to manage risk. You got to adapt your strategies based on evidence.
And it's about having a framework for making smart decisions, even when things get crazy.
Exactly, because the market can be a wild ride.
Absolutely well said. So there you have it, folks. A deep dive into advanced portfolio management.
Hope you enjoyed it.
Thanks for joining us. And until next time, happy investing.